Hey, how's everybody? In this video, we're talking about the new Washington State Long-Term Care Trust Act. So in this video, we're talking about what that act is, how it works, how do we get vested in it, how do we opt out of it, and more importantly, should we stay in it or should we go somewhere else? So all that will be covered in this video. If this is your first time here, make sure to like and subscribe so you don't miss future updates just like this one here. So what is this Long-Term Care Trust Act? So simply put, it's this new payroll tax going into effect January 1st of 2022. That's going to be mandatory for all W-2 employees. Now the tax collected is going to be put into a trust to help fund long-term care in the future. So this payroll tax is mandatory for W-2 employees only, but not if you're self-employed or a 1099 employee. If you guys want to opt into the plan, anyone that's self-employed can choose to opt in, and people that are W-2, you have an opportunity, a one-time deal only, to opt out. If you want to opt out of this new tax, you have to have private long-term care coverage in place before November 1st of 2022. Now I'll come back to that more in a bit. So what are the benefits to this Long-Term Care Trust Act for those that are actually vested in the plan? The Trust Act will actually pay up to $100 per day for long-term care coverage, up for a total of 365 days or a full year. Now these $100 days can be stackable. So you can use that entire $36,500 limit within a full year, or you can use it in 6 months or 3 months or pretty much however the bills stack up right until you hit that limit, then the benefits stop. So how do you get vested in the plan? To be vested in this plan, you need to be paying to the system for 10 full years, and 5 of those years have to be consecutive. Another way to qualify for benefits is you have to be paying 3 of the last 6 years. So you're paying it for 10 years, you're vested, so at some point in the future you're going to be able to use benefits. For those that need to go and claim sooner, as long as you have three paid years in of the last 6, you go and claim. So if you start paying this thing in 2022, and say in 2025 you're in need of long-term care assistance and you paid into it for those 3 of the last 6 years, you could go on benefits then. So as soon as someone could even receive benefits is in 2025. But for most people, you're gonna have to pay into it for 10 years, and that benefit will stay with you until the future if you need it. Now, what if you don't need the benefits? Well, then it just gets absorbed into the system and it helps somebody else out. Now, with this long-term care coverage, it only covers people in Washington state. So if you choose to move abroad or to a different state, you're not covered. If you move out to a state for a few years and want to decide to come back later in retirement, if you're gone for more than 5 years, you also lose the benefit. So this thing is really strict and kind of wonky in how it all works. Now, this payroll tax has no income limits, so it doesn't matter if you make $100,000 a year or $1 million a year, that payroll tax applies to all of your income. Now, this payroll tax will also probably increase in the future as costs go up. In fact, the actuaries already said that the 0.58 is not able to sustain the program unless maybe if they're able to invest the funds into equities and the equities actually perform. So a lot has to go right for that to happen. So more than likely, you can expect this tax to increase in the future. The 0.58 is set to stay in force until 2024, and after that, who knows? We'll see when we get there. Well, that's a huge risk for those people with higher incomes in the plan. You'd hate to have your bill go up significantly just because they decided they wanted to take more tax from it. All right, so now we know more about what that plan is and how it works. You might be thinking, should I opt out of it, or how do I opt out of it? It's probably a better question. So in order to opt out of it, you need to have long-term care coverage, private long-term care coverage, in force by November 1st of 2021. So remember, it has to be in force or effective by. So if I apply for the benefits on November 1st, that's too late. The policy has to be issued before then. And policies can take anywhere from a couple weeks to even a month or more to be issued. So if this is something you're really serious about, you want to make sure you start the process as soon as possible and don't wait. You'd hate to start the process in October. It takes a little longer than normal because everyone's trying to get in and you don't get approved to December. Then you're going to miss the exempt period. So be careful not to delay too long on this. So if you're going to look into getting private long-term care insurance, there's a couple things you have to know, is that there's different types out there. Some will be covered in the exemption, some are not. So the ones covered in exemption are the traditional long-term care insurance, the life insurance with long-term care riders, annuities with long-term care benefits attached to them, or asset-based long-term care plans, or otherwise known as hybrid plans. The ones that aren't covered are there are certain life insurance policies out there that have this thing called a chronic or critical illness rider attached to them, that when you read the definition, it still covers long-term care. You fail 2 of the 6 daily living activities, it pays out benefits. But just the way it's structured and priced to the contract, it falls under a different tax code, and therefore in Washington state size, it doesn't count as long-term care and it does not count. So if you have one of those policies with that kind of rider on it, that's not going to cut it. So now, what are the differences between those long-term care plans? Which options should I pursue? By far, if you're looking for just the cheapest thing to, where can I put money in to avoid this tax, the cheapest thing out there is going to be standalone long-term care or just traditional long-term care. It's sort of like term insurance. It's use it or lose it. You'll be paying the premium every single month until you pass away. It never stops. It's never going to be paid up. When you compare it to like the Washington State one, it's a payroll tax, but once you're not working anymore, the tax stops. You're no longer paying it. So just some things to be aware of there. Also, this private long-term care thing, there's no company out there that guarantees the premium. So while it may be cheaper today, they have the right and often will do so, is raise the premium in the future on you. So while you may get a policy for say $50 today a month, it may go up to 80 or 100 or 150. Who knows? It's pretty much up to the company on what they want to charge you, and there's nothing you really do about it. If you decide not to pay it anymore because the costs are getting too high, then you'll have to cancel the coverage, and there goes your long-term care, and all the money you paid into over the years is totally gone. So for that reason, I'm not a really big fan of traditional long-term care insurance, but if you're looking for something just cheap and easy to get the exemption, that's going to be the route you want to pursue. Some key benefits with the traditional long-term care insurance, though, is unlike the Washington State ones, it is portable. So it works no matter what state you live in, and even if you move abroad to certain countries like Canada, it'll also cover you there. The benefits are 100% guaranteed, and they will last for a minimum of 2 years. So the funny thing here is Washington State has these requirements for what insurance companies have to provide in order for it to be counted as long-term care insurance. So basically it states that you have to provide a benefit of $50 a day for a minimum of 2 years. And the Trust Act says it's $100 a day for 1 year. So by definition, they don't even meet their own credentials to be considered long-term care. So I guess you could call it short-term care. Any of these other private carriers will have to meet those standards. So you're going to be able to get at least an extra year of benefits out of those plans. Ideally, if you're purchasing long-term care, you want to make sure it's the right plan for you. You probably want to get more than just bare minimum coverage, and you more likely want to get one that's going to last more than 2 years, just in case you may need it for longer. Now, outside of just long-term care, you have another affordable option is life insurance with a long-term care rider attached to it. So these life insurance policies are permanent policies, so they're with you for the rest of your life. They have a long-term care rider that you pay an additional fee for, and basically it's just going to accelerate the death benefit to you. So if you have a policy, say, where the death benefit is $300,000 and you never needed long-term care and you passed away, then you get a death benefit of $300,000 to your family. Now, if you need to use the long-term care feature on it, they're going to be accelerating that death benefit to you either at 2% or 3% on a monthly basis. So now what does that mean? If I had a $300,000 death benefit and my benefit was 3%, I get 3% of that $300,000 or $9,000 per month until that money is exhausted. So it'll get you by for a couple of years. So if you already have permanent insurance, it may make sense just to replace that old policy with a new one and get that long-term care in it. So I know one concern many people have with permanent insurance is that it costs way too much and it's really expensive, but realistically, it's probably cheaper than you think and cheaper than carrying a term insurance for an extended period of time. In addition to it, in the CARES Act bill of 2020, there is a page hidden way back in the stack that reworked how life insurance companies can price their insurance products. So in other words, the cost of insurance got adjusted downward. So it's cheaper in 2021 than ever before to buy life insurance. So it's definitely a route that I would recommend pursuing over the traditional route, just because it provides you both a death benefit should you never even need the policy, but also will last you a lot longer, and you'll be guaranteed the premium is never to increase. Now, the other type of coverage that you can get is annuity-based long-term care. So if you have a chunk of money that you want to put somewhere to generate long-term care benefits, that's pretty much what it is. I have $100,000 I don't need in my bank, put it into the policy, it's going to pay me a certain benefit for life. Now, where that benefit cuts off at some point, where it's unlimited, it's going to depend on the product. But what's also cool is there are companies out there that will take pre-tax dollars. So if you have some extra money sitting in, say, like an IRA, for example, you could use the pre-tax dollars to purchase long-term care without any kind of upfront adverse tax effects. So it's just some new industry designs that can really benefit you guys. Now, the last and final option you have is what we call asset-based or hybrid plans. Now, it's a hybrid because it's kind of a cross of the life insurance and the traditional long-term care plans. So the way these policies work is you're able to buy a certain benefit at a dollar amount per month. The premium is, in this case, is guaranteed never to go up, and oftentimes they're paid up at a certain point. Whether you want to pay to age 95, pay for 20 years, 10 years, 5 years, it's kind of up to you on how you want to pay it. but it just gives you the option that if you can have a paid up policy so you don't have to worry about ongoing bill in retirement. In addition to it, in the event you never even need long-term care insurance, it has a death benefit attached, so it pays out tax-free to one of your beneficiaries. So your money doesn't go to waste like the traditional long-term care plan. So these hybrid plans are a really popular option for many people. If you guys need help on deciding which plan would be best for you or the best route to go down, then all you have to do is book a call with me in the description below, and I'd be happy to walk you through your options and see what could be a good fit. Because the last thing you want to do is delay on this, get stuck into this long-term care tax thing, be paying on it, and then in the future decide, hey, I need more long-term care, then have to go and put out more premium dollars for long-term care plans. Then you're kind of double paying, one for inferior benefits that you may not even get anyways, and one for a permanent plan that you probably would receive should the need arise. I hope this video helps you guys out. If you want to learn more about those long-term care plans or see examples of how they work, then check out these videos over here, and I'll see you guys next week. And remember that your future depends on what you do today.